Okay, what is business valuation? Business valuation is basically the one where we are valuing our business or we are valuing our assets. Why do we want to calculate the value of our business, or why do we want to calculate the value of our assets? For example, we want to take over a company or we want to merge ourselves with another organization, then definitely we will calculate the market value of the business. Because you want to do what? You want to acquire another organization, or you want to buy and hold this organization or investment, or you are valuing the companies because you want to enter in the stock market, or you want to establish the value of shares which is held by retiring directors, or you are calculating the value to determine capital gains tax, inheritance tax, or we are calculating the value of the business to determine divorce settlements. So these are the basic motives of the valuation of a business. Or in short, we can say that minimum usage is either we want to sell our business or we want to purchase our another business. That's why we will determine what we will determine the value of the company or value of the organization. Next one is approaches to valuation. There are three main approaches to valuation. First one is asset based, where we are using only the tangible assets. Second one is income based, and the third one is cash flow based. First one, market capitalization. Market capitalization or value of the company means we are calculating total value of the organization. Market capitalization means we are calculating total value of the organization where we will multiply market price per share with the number of shares, or we will multiply price per share either determined by dividend valuation model or earnings model, or whatever model we use, we will multiply it with the number of shares. So please remember that there is a difference between these two words. One is called the share price. Share price means we are talking about only one share, and market capitalization or valuation means what? Market capitalization or valuation means where we are multiplying market price per share with the number of shares. Next one is real worth of the company. What is the way? The valuation is described in art, not a science. Real worth of a company depends on the viewpoints of various parties. The various method of valuation will often give widely differing results. It may be the interest of the investor to argue that either a higher or lower value is appropriate. The final figure will be a matter of negotiation between the interested parties. So the real worth of the company. Valuation and art, not a science, means what? It means that whenever you want to acquire a company, you will definitely evaluate the market price. But market price is based on some characteristics or some features, which includes what? Which includes like our future earnings, which includes expected dividend growth rate. The acquisition of a major competitor may enable a company to secure a dominant position. If you are acquiring one of your major competitors, it means you are going to strengthen your market power. which will increase your market share. But definitely it is not possible to acquire major competitor easily, because major competitor will also resist against our intention of acquisition if they are not willing to sell. And the second major issue, or the second issue, is are we allowed by the competition commission to acquire another organization or big competitor or not? If we are not allowed, then definitely it is not possible for us. It is therefore likely to place a higher value on the target company than a potential purchase from outside the industry. A realistic valuation will therefore require a full industry analysis rather than an isolated assessment of the business to be valued. In some cases, circumstances giving rise to valuation may call for a value as would be agreed between. Basically, he is saying that if you are going to acquire a company, not and this acquisition is not a forceful acquisition, you are not targeting a company that you want to acquire the a competitor in either circumstances. Basically, competitor is also willing to sell their operations, or a company which is in within the same industry but not exactly the similar size company, cannot be considered as a competitor. It's a small company in our comparison, and they are willing to sell their business operations to us. Then it is definitely not a forced acquisition where someone is trying to acquire us. So in this case, what will happen? In this case, we have to determine a negotiated price where both the parties will be willing. That a willing seller may often be subject to independent arbitration, and a willing buyer as well. Where both the parties are willing, then definitely it is possible that we can determine the valuation of a business, which is called a negotiated price. And definitely this negotiated price will be greater than the current market price per share, because if you are expecting that there will be growth in earnings, so you are expect saying that this company is a growing company, or this company has a potential to grow. So that's why you have to pay higher price to acquire this company, or this is called what premium, or in group accounting we call it goodwill. Whenever we want to acquire a company, we will definitely calculate the valuation of that business. And to calculate the value of business, we have different types of information. The most prior information is financial statements. First of all, we will look at the financial statements of the company. Second, supporting listings such as non-current asset with depreciation schedule. The third one is we will examine the existing contracts. Next one is we will use budget or projections for the future. Next one is we will use background information on the industry and key personnel. So this information is needed for valuation or exercises. Asset-based valuation. Asset-based valuation is called what? Asset-based valuation is called that how to calculate the value of the company. First one is book value basis. Book value simply means total assets minus total liabilities. And total assets means what? Total assets means non-current assets plus current assets. So while reading question, read or find non-current and current assets quite carefully. And the other one is called total liabilities. Total liabilities includes what? Total liabilities includes non-current liabilities and current liabilities. At times, students makes mistake and they add equity and reserves in the non-current liabilities, which is an incorrect approach. So identify these values carefully. In fact, difference between total current assets and the total current liabilities must be equal to what? It must be equal to equity. We can say that this is basic accounting equation. Equity is what? Equity is equal to total assets minus total liabilities. Next one is net realizable value. We also call it breakup basis. Suppose if we are not expecting that this organization can continue for next accounting period, or this organization has no going concern. So in this case, we will use breakup basis. This will determine minimum acceptable value for the owners. Valuation problems, especially if quick sales, if you want to sell immediately, or and you are more willing to sell in comparison with buyer, definitely you have to sell at the lower price in comparison with buyer. Replacement cost is used when a company has going concern. We are expecting that this company will continue for the next 12 months, and after that it will proceed. So in this case, we will value our organization at the replacement cost, or we can say that market value. So in this case, our assets are valued at what? Our assets are valued at market value. Next one is problems with asset-based valuation. What are the problems with the asset-based valuation? Number one is the fundamental weakness. Investors do not normally buy a company for its statement of financial position. Definitely, people do not buy a company on the basis of financial position. People buy a company on the basis of what? People buy a company on the basis of earnings. People buy a company on the basis of cash flows. They determine the value of the company on the basis of profitability and cash flows which were generated in the past, which we are expecting in the future as well. There are a few subsidiary weaknesses, that highly skilled workforce. If a company has a high skilled workforce, it is definitely an intangible asset, or we can say that it is an intellectual property. How can we determine the value of the a highly skilled workforce? We cannot determine the value of a strong management team. We cannot determine the competitive position of the company. So these are the weaknesses in the organization. Next one is when asset-based valuation are useful. Number one, for asset stripping. What is this asset stripping? Asset stripping means where we are acquiring an organization with the intention to sell, sorry, we are where we are acquiring an organization with the intention that we will sell its assets, or we will sell the acquired organization into different pieces. So this is called what? Asset unusual. Their company is going to purchase to broken up and its assets are, because we are expecting being an acquirer that when we will sell the assets of this company, we can sell assets of the company at higher price in comparison with the whole company. To identify a minimum price in a takeover, we are going to identify minimum price in a takeover. To value property investment companies, or we are going to value property investment companies. Types of asset-based measures. First one is book value or nominal value. We are done with this. Breakup basis, where there is no going concern. Replacement cost or deprival value, where there is the going concern of the organization. Next one is earnings-based model or income-based model. Earnings-based model or income-based model is basically what? Where we have earnings, or we are determining the value of the organization on the basis of earnings. There are two approaches to for the earnings based method. First one is called price earning ratio method. Basic formula of the price earning ratio is what? This is the basic formula of the price earning ratio. Now, in this case, you are not required to calculate price earning ratio. You are required to calculate the value of the organization or share price of the organization. If you are asked to calculate the value of the company, as I told you in the start, that value of the company means market capitalization, where we are multiplying our total earnings with the price earning ratio, or where we are multiplying our per share price with the earnings per share with the price earning ratio. Problems with the price earning ratio, that price earning ratio, it is the first one is private company and its share may have less liquid. What is meant by less liquid? Less liquid means not easily saleable, because private company is the one which is not listed in the stock market usually. When it is not listed in the stock market, then we cannot determine its market value quite easily. When it is difficult to determine the market value, then definitely it is not easy to sell at the market price. So, what will we do? We will use the price earning ratio of the similar size public company or the listed company to calculate the value of the organization. And remember one thing, whenever we say earnings, we always take profit after tax, earnings per share, or earnings. Second one is method is called, one thing I would like to add, which is missing in this study text. It is called with growth. Growth means what? Growth means we are calculating share price or value per share is equal to EPS into 1 plus growth rate of the earnings, or here I am going to write earnings growth rate, bracket closed, multiplied by P ratio, multiplied by P ratio. Next one is value of company is equal to earnings into 1 plus earnings growth rate into P ratio. So remember this formula as well. Next one is earnings yield method. Earnings yield method is basically based on output. Yield means output. Where we are doing what? Where we are calculating EP, we are using EPS divided by price per share into 100. Value of the company is equal to total earnings multiplied by 1 divided by earnings yield, or EPS into 1 divided by earnings yield. So how to calculate the value of the company, or what does he wants to say? He is saying that earnings, what is the formula of earnings yield? Earnings yield is equal to EPS divided by price per share, or market value. So to calculate market value, we are going to do what? We are going to rearrange this equation, and EPS is divided by earnings yield percentage. Earning yield is provided in what? Percentage terms. And price earning ratio is provided in what? It is provided in times. Another formula of the earnings yield is this one. Just like the dividend valuation model, value of the company is equal to earnings multiplied by growth rate. Here we are using growth rate of the earnings divided by earnings yield minus earnings growth rate. So this is another approach to calculate the value of the organization. You can see that he is saying that company A has earnings of 300,000 growing at a rate of 3%. A similar listed company has an earning yield of 12.5%. Okay. So calculate the value of each company. First we will calculate the value of A, 300,000 into 1.03 divided by 0.125 minus 0.03. So 300,000 into 1.03 divided by 0.095. Value of the company is 3252,632. Here we have similar size. Company B has earnings of 420,000. A similar size listed company has a P ratio of 7 times. So if we use P ratio method for this organization for 20,000, for 20,500 into 7, value of the company is 2,943,500. So these are the methods to calculate the value of the organization, or this is the answer. Let me check with this as well. You are given the following information regarding a company, an unquoted company. Ordinary shares in capital is 400,000. Number of shares 25 cents is the par value or nominal value. Extracts from the financial statement of profit and loss for the year ended 31st July 20x4. Profit before taxation 260,000. Corporation tax is 120,000. Profit after taxation is 140,000, less preferred dividend 20,000, then ordinary, and we have retained profit 84,000. P ratio applicable to similar type of business suitable for an unquoted company is. You are required to calculate the value of 200,000 shares in a company on a P ratio basis. So P ratio is 12.5 and earnings after tax are 140,000. 140,000 into 12.5, 1,750,000. Total value of the company divided by what? Divided by 400,000 shares. Per share is 1,750,000 divided by 400,000. Per share market value is 4.375. He is saying calculate the total value of 200,000 multiplied by 200,000, 875,000. Alternatively, what can we do? We can divide it by 400,000 and first determine EPS. 140,000 divided by 400,000. 0.35 into 12.5, 4.375. Price per share is same. Either of the approach can be used. Multiplied by 200,000, definitely you will get the same answer, 875,000. So this is the value of the organization by using these two different approaches. Come to this understanding, following is an abridged version of the statement of the financial statement, financial position of G Contractors Company, an unquoted company. As at 30th of April 20x6, loan notes are redeemable at 2%. Current market value of the property exceeds book value by 30,000. All assets other than the property are estimated to be realizable at book value. Calculate the value of 80% of the shares on asset basis. If I simply use asset basis, total assets are what? 550,000. He is saying current market value exceeds book value by 30,000. All are estimated to be realizable at their book value. If I am using only book value, then I will say 550,000 minus long-term loans 100,000 is equal to equity of 450,000. And you can see that equity is 450,000. And divided by number of shares, 200,000 is the total value, $1 par value. So we can say that total value is divided by 200, or we can simply multiply by 80% to calculate the value of the organization, which is 360,000. Alternatively, if we are using replacement by method, then 550,000 plus rise in the market value, which is 30,000. If we are using going concern for replacement cost basis, minus long-term loan of 100,000, and it is redeemable at a premium of 2%. So suppose if I use rather than 100,000 2% premium as well, and I assume that market value is, although this is not the market value of the loan notes redeemable, and it is April 6 and redeemable at Z1, means after 5 years. First, we have to calculate the value of these loan notes. You need to learn this, how to calculate the market value of loan notes. 6% loan notes are provided. Here, cost of debt is not provided. So, I'm not calculating over here. Maybe in upcoming example, we will get the value. So, this is the value as per net book value basis. Next one is cash flow approach. Cash flow approach is alternatively called what? Dividend approach, where P naught means recent price is equal to D. If I am using simply D, it is called dividend, or it is called next year dividend. It is called next year dividend. Or I can say that no growth in dividend. Or I can say that this value of the dividend in perpetuity. So I cannot calculate that what would be the dividend value. Otherwise, D naught means recent dividend, recently paid, into 1 plus growth rate. It is dividend growth rate. Previously, we learned earning growth rate divided by RE. RE stands for cost of equity minus growth rate. Strength and weaknesses of dividend valuation model. There may be problem estimating a future growth rate. It is difficult to determine the future growth rate. It is assumed that growth will be constant in future. This is not true of most companies. The model is highly sensitive to changes in its assumptions. It assumes that growth rate is lower than the shareholders' required rate of return. For controllable interest, it offers few advantages over the earnings method below. So here we have a company has following financial information available. Share capital in issue 4 million ordinary share have a nominal value of 50 cents. Current dividend is 24 cents. Dividend for the 4 year ago is 15.25. Current equity beta is 0.8. You also have the following market information. Calculate the value of the company. So first I need to calculate dividend growth rate. Recent dividend is 0.24. Earliest dividend is 0.1525. Raised to power 1 divided by, it was 4 years ago. So 4 minus 1. And when you are working in Excel, make bracket before, start bracket before 4 and then close the bracket after minus 1, and this whole equation is minus 1. So 0.24 divided by 0.1525, this whole raised to power 1 divided by 3 minus 1. 0.24 divided by 0.1525. This raised to power, it is 16.3. Growth rate is 16.3%. Secondary, I would have to calculate cost of equity. Data for the CAPM is provided. 8 plus market return 15 minus 8 into beta equity. So 15 into 0.8 plus 8, cost of equity is 20%. Now we have dividend per share of 24 cents and shares are 4 million. We are required to calculate market capitalization. So we will calculate total dividend, which is equal to 0.24 into 4 million. 0.24 into 4. It is 0.96 million. Now 0.96 into 1.163 divided by 0.20 minus 0.163. 0.96 into 1.163 divided by 0.20 minus 0.163. It is, I think, 30 million. 30.175 million. Okay, so this is the right answer. Next one, once again, calculate the market value of the company. How to calculate? Total 2 million shares. Recent dividend is 18 cents. EPS is 25. Current asset earned on the return earned 20%. Equity beta 12.1. So first of all, we will calculate KE percentage. 5 plus 12 minus 5 into 1.1. So 7 into 1.1 plus 5. 12.7%. Now dividend growth rate is not provided. No issue. We can calculate the growth rate. Growth rate is equal to return on assets or return on equity multiplied by retention rate. Our earnings are 25 cents. We are paying dividend of 18 cents. 0.18 divided by 0.25 into 100. 0.72 is or 72% is dividend payout ratio. So 1 minus 0.72 is equal to Point 2 is retention rate. So the growth rate is 0.056. 0.18 into 1.056 divided by 0.127 minus 0.056 into, so we have share price of 2.67771. How to calculate the market value? Into 2, 5.3543 million is the market value. Let me check once again. Next one is another question. The following information has been taken from the statement of profit or loss and statement of financial position of B company. Revenues, production expenses, admin, tax allowable, capital investment, corporate debt. Tax is 30%, VAT is 16.6, and what is these are the few, these cash flows are expected to continue every year for the foreseeable future, which means indefinite, and calculate the value of the company. Okay. So if I say revenue, production expenses, administrative expenses, these will be deducted and tax allowable depreciation is added. So first I will determine my cash flow. 350 minus 210 minus 24 plus 31 147. It is using what? Discounted cash flow basis, which is saying identify free cash flow, operating flows plus revenue from the asset, tax, deduct the ongoing asset expenditure, add synergies, then select the suitable time horizon, calculate the present value. This will give all and deduct the value of the debt to leave the value of the equity. Remember, this is called value of equity is equal to total value of firm or the company minus total value of debt. If question asks you to calculate the total value of company with this data, in this case, value of equity plus value of debt. Okay. WACC is 16.6%. Capital investment is this. Tax is 14 million at 30%, 130%. So if I calculate profit before interest and tax, I would say 350 minus 210 minus 24. 116 million profit before interest and tax, PBIT. which is called operating cash flows. Add back the revenue from the sale of assets we don't have. Then he is saying what? Tax, deduct ongoing uh, asset expenditures. Okay, if we add back tax plus 14, it is 130. Deduct capital expenditure 48, so you will get 82. Select the suitable time horizon, calculate present value. This gives the value of all the providers. Deduct the value of debt. Okay. So now you have what? You have the profitability. It is multiplied with what? It is multiplied by 1 plus growth rate divided by WACC minus growth rate. So if I